welcome back to this very special edition of Indianomics, where I have two guests from JPMorgan who are experts on Asian economics, and of course Luis, who is an expert on global macros, commodities, rates and currencies. Jahangir Aziz, of course, we know very well. Jahangir, let me come to the India story. Exports have been reasonably helpful to us. Do you think the growth story, which is kind of hovering between 6.8 and 7, can get impacted by what's happening globally? Would you bet on a 6.8 to 7 growth?
No, I would even bet on a high growth rate. If oil price falls to $60 or below that thing, just because that's the way CSO measures growth, but deflating 75% of nominal GDP by WPI, you can get 8. I mean that is not the issue. I think the issue is that for at least 2-3 years now, we've been running essentially on two engines of growth. One has been public infrastructure, and the other has been export of services, not export of manufacturing. Those two still remain the only two engines of growth. You look at the budget, look at what the government policies are, look at even the design of infrastructure that has been proposed. It is again geared towards keeping just those two engines of growth. So you have to tell me how long will these two engines of growth will last. So the first engine of growth, which is in the hands of the government, which is public investment, will continue. This budget still has a significant amount of public investment planned. In addition to that, the state governments have also joining in hands with the central government. So I'm reasonably comfortable that the public investment part will continue. That leaves you with the other engine of growth. The other engine of growth is export of services, and that's where I think the concerns about US comes into play. I don't think that a recession by itself is bad for the expansion of global capability centers in India. That is the basis in which the export of services has been going on.
Yes.
I think it might actually even further that's almost like a recession trade that you do. That if you go into a recession, then you would want more of your back offices, more of your support services to be located to a lower cost center rather than a higher cost center. So even if there's a recession, I think that part of the services sector story remains pretty much intact. The question then is that are those two drivers of growth sufficient? Do we really need to broaden our drivers of growth? Obviously we do need to do. You can't just run an economy in just two drivers of growth. The driver of growth that we have been waiting for since when? 2012, private investment, we're still waiting for it. And that's where the key concern is, that after what, 8, 9, 10 years of waiting for it, why are we still waiting for private investment to come back?
The more important currency commodity questions to you, Luis. First is the dollar index. It's shied off 100, taking support over there, but should we be prepared for much lower levels? The JPMorgan expectation is 5 cuts, 2 already delivered.
I think that we need to watch very closely the next couple labor market reports. I think that the U.S. labor market is going to be what determines how much more the Fed cuts. Our U.S. economists still have 50 basis points for November,
yes,
and then 25 basis points subsequently, taking the policy rate from 5% where it is right now to 3% by July next year, right? But the pace of that depends on how dramatic the labor market deterioration is. So let's see. We're all going to be in data watching mode. But I think that what is clear though is that the Fed is feeling sufficiently comfortable that the balance of risk between growth dynamics and inflation dynamics is more balanced, and they call it we're recalibrating.
So
right?
You don't see a sharp dollar index fall?
The dollar index. In the current scenario, as you know, the dollar already peaked. It has been moderating. It has been falling. partly because of the expectations that the Fed will cut. Now the Fed has cut, it has delivered on that, and the expectation, generally speaking, that the U.S. economy is going to fall into what we call a soft landing. That combination, soft landing plus lower rates, should go actually against the dollar and allow it to continue to moderate. EM currencies, you guys are feeling it here in India, should appreciate against the dollar. But let's also hold our breath there, because if the Fed has to do more, because we're actually getting closer to recession territory, recession risks, that would actually at some point flip the dynamics for the dollar. The dollar always tends to appreciate in the initial phase of a recession because of global deleveraging and because of flight to quality into U.S. assets. So, again, we're holding off on discussing U.S. elections.
Yes.
Everything that we hear about that points to a stronger dollar as well, right? So
yes.
I think that it is a little bit of a dicey moment for the U.S. dollar, where fundamentals right this minute are pointing to further depreciation of the dollar.
The one that's under-discussed is the U.S. fisc. Neither of the parties are speaking about lowering the fiscal deficit.
Right.
So do you think that has some implications for the U.S. yield curve? Even if there are cuts, the 10-year doesn't dip much.
So,
or what are the implications?
So I think the 10-year is pricing in continued large issuance, at least for 25 and 26. So as Luis said, a lot of policy changes can happen. Some of the policy changes that can happen are immediate. Some of the policy changes will take a long period of time, and it will also depend upon what is the composition of the Congress. And the ones that will take a long time and will depend on the composition of Congress is what is going to happen to fiscal policy and what is going to happen to deregulation, what is going to happen to the structure of the Fed. Let's not forget that in 2026, yes, the large portion of the Fed, including the chairmanship, comes for renewal. But those are things that will happen, probably take 25, and probably we'll see that in 26. In 2025 per se, if we get a divided Congress, chances are that because you'll have to go into a reconciliation between the Senate and the House, it is very difficult to see that the U.S. continues to pump in very large deficits, unless you get into a recession.
So deficits may come under control.
Deficit almost mechanically falls because there's a reconciliation, right? It will almost make sense. But it is not a very large fiscal drag. Okay. It is a modest fiscal drag. I think, as Luis was pointing out, and something that we should be talking, and I'm guessing the market will start picking on, is that immediately you will get the tariffs and immigration and the impact on immigration. Both of them are seriously inflationary for the U.S. economy. And don't need Congress support. And by the way, the market is going to price that in on November 4th. They are not going to wait for January to read the tea leaves, right?
But Luis, there is a lot of interest in commodities now. Where do you see crude headed? And equally important, where do you see base metals like copper and aluminum headed?
So, oil, supply-demand has been rather tight. The balance has been rather tight in the last couple of years, and this has been because there's been quite a bit of an increase in non-OPEC supply that has been matched in terms of cuts by OPEC plus countries, particularly Saudi Arabia and most recently actually Russia. Yeah. That has allowed oil to remain in a range of 70 to 80, with some exceptions during particularly short periods of time. But because we are expecting supply to continue to increase by non-OPEC producers, including the U.S., including countries like Brazil, like Senegal, like Guyana, Suriname, the question here is, are OPEC countries, particularly Saudi Arabia, going to be willing to continue to lose market share in order to, keep cutting production in order to stabilize markets, or are we reaching their degree of tolerance? At this stage, Saudi Arabia is producing. So we are, our own forecast is looking at prices in the low to mid 60s by the end of 2025, in the fourth quarter of 2025. This does not include anything, again, about the U.S. elections. So I would say that on oil, which is actually very supportive for India, you know, the outlook is for lower prices, right? For metals, the picture is a bit more mixed, and I would say that copper is probably the one where we hold the most optimistic view, even though most recently there's been a downward correction. A lot of this correction has been honestly driven by profit taking from financial investments in copper, meaning ETFs or financial contracts, and the trigger has been the weak Chinese data. What is interesting, though, that the demand from China itself, they seem to be price sensitive. So during the rally, they stopped buying, and in the last few weeks, when prices collapsed, we have seen them come back to the market to buy. So we saw the peak earlier this year, $11,000 per metric ton of copper. We're now in the 9,000s. We're actually expecting the 11,000s to come back. Something not too different, honestly, is what we're expecting in aluminum. What is more interesting, that is also matters, I think, a lot here in India, is gold.
Yes.
Gold is where we have a very bullish view, and this is because apart from gold being used as an inflation hedge before, right, and being used as a way of insulating the possibility of more geopolitical events and sanctions and the weaponization of the U.S. dollar. Now we have the Fed cutting, and there is this inverse relationship. When real rates in the U.S. go down, all prices tend to go higher. I think that our team has, projections, maybe another, 10-15% increase on average between this year and next year. So that's an interesting number. Right?
Okay. Stock markets everywhere, especially in India, are like reaching out to the skies. Anything hidden in plain sight in the form of red flags?
So the red flag for me has always been the case that in the emerging market world, there had been one leader who had the size and the breadth to absorb very large inflows of equity flows, which was China. You've taken China out for its own problems in China. We now want to relocate money from Chinese allocations to MSCI. India is already ahead of China. But in the rest of the emerging market world, there is no space. There's only space in the US. If you bring in even 1-2 percentage points of the allocation that made into China, into India, let's say, you're immediately going to run into overvaluation concerns. And that will stop the trade out. I think that is where my concern is, that you just might get stuck in this equilibrium where nobody wants to move, but because nobody can move.
Yeah, but as experts tell us, valuations are never a good enough reason for the market to fall, which is why we are looking for whether there are other flags. In any case, I think the big story is that gold is headed for greater highs. Thank you very much, Luis and Jahangir, for speaking with us.
Thank you for having us.